Before April 14th, are there deals you did because of the pressure and the froth in the environment that you would undo today?
If there is a venture capitalist anywhere on this planet who doesn't say that they drank some of the Kool-Aid, they would be lying to you. My partner John Hummer likes to say we drank our own bathwater, which is a worse metaphor than drinking Kool-Aid. So yes, we did believe that there was some opportunities in e-tailing. We made 2 investments. Both became public companies, Pets.com and Home Grocer. Home Grocer has recently, in a very smart move, merged with Webvan, so the company has a solid cash position, literally hundreds of millions of dollars. But we, 2 years ago, believed that both Webvan and Home Grocer could be built as standalones. Fortunately, the companies on their own decided to combine to build a larger, more stable entity. But we did discover, like everyone else, given the climate of so much money chasing all these deals, that the e-tailing sector became polluted with cash. Very expensive to build distribution centers and get them right. Not hard to get the customer or keep the customer unless you're competing with 29 contenders in your marketplace. Very challenging to integrate supply chains and demand chains. Lots of software involved there. All of that costs money, and in a very flush with cash environment, the land grab costs were enormous. So I think everyone right now is standing back and saying, should we have invested in e-tailers? We changed our strategy and invested in a multi-channel retailer called Dean & DeLuca. They already had catalog operations. They already had brick and mortar installations. They're a well-known brand. They had a brand established. They had 18% same-store growth, and they needed some assistance by an investor on expanding their internet channel as part of a multi-channel retailer strategy. So that was the last retailer that we did. And again, it's very different than a pure e-tailer. It truly is one where many of the costs, brand building, distribution, supply chain integration, were already in place, and we could build value by leveraging the internet channel versus having it as our only one.
You've positioned this correction that we've all lived through in the tech sector, internet sector on the NASDAQ, largely as a return to rationality and the laws of gravity, et cetera, that existed 2 or 3 years ago before this boom or boomlet. Some people say, and it's been argued quite prominently in the last few months, that in fact this will cause people like you who have been aggressively funding innovation, whether it's enabling technologies and software or it's actually consumer business concepts like e-tailing, that this will put a damper in this new climate with a focus on profitability on innovation.
I don't think so. I don't think Me Too companies are innovation. And it has actually, the amount of money flooding in a short period of time has actually in some cases suppressed innovation, because the companies that were much more deeper technical components of the market map were sort of ignored by glamorous companies. I'm not sure anybody can remember the name of the CEO of the Globe, or I was at a conference recently where 1,300 people, none of them could tell me what the Globe did, but it was the cover story in 1998 for everyone. And at the same time, companies like i2, who is a very innovative company, not one of our portfolio companies, funded in 1987, by the way, who is in workflow automation for manufacturing and enhancing innovation in both the demand and the supply chain, saw their stock plummet to 6 because they weren't glamorous. So we will see a reconfiguration of the market map where people have a better lens on, do companies really have a functional role? Is there a value proposition for customers? Can you build a business out of this? Is there a high-quality management team? Pretty much ignored in the last 30 months. So very solid leaders saw themselves cast off because they didn't have the best teeth for photo shoots. So we will see a lot of that nuttiness go away. Incubators. People were polishing up business plans as if they were scripts to Hollywood movie makers. Gone. So a lot of the artifacts, theme-based investing, B2C, B2B, P2P, it didn't describe any companies. Even wireless does not describe the customer value proposition. It's a theme. And so it went way beyond sentiment and sectors, and everyone lost track of the customer value propositions, fundamental business propositions, great management teams, and now real companies will shine. It's not going to be, were you the prettiest contender in the hottest theme anymore, which to me is fabulous.
How did we get into a world where $90 billion was actually allocated to a large measure based on flavor of the month kinds of focus in the market?
Well, we had a couple things happen. One is that individual investors came onto the scene. Everyone felt they understood investing and had access to very inexpensive trading. In fact, many of the companies today find most of their stock being held not by traditional institutional investors, but by individuals. These individuals were not educated in the fundamentals of the market. Now they're watching CNN, CNBC, and people are saying we're going back to fundamentals. You should ask people asking, what are fundamentals? Do I know how to do discounted cash flow? What are the valuation metrics? How do I calculate these? So we brought into the market 50 million or so individual investors or more. We also then saw an insatiable demand for them for news on anything. You know, this company's hot, that company's hot, and they were investing against those trends. It was, investing became a trend-driven, fashionable experience. It also allowed more companies to go public. This euphoria carried into the public markets. We also had a very calm world political environment. We had, really low interest rates. We had no issues associated with oil. We weren't looking at a crisis in the Mideast. So everything was perfect for euphoria.
And to have an exclusive focus on financial life. I mean, people talk about this revolution you're describing as the reason that a CNBC or a CNN actually exists.
Right, and one of the seminal moments for me was I was listening to National Public Radio on my drive back from one company to the next in the Bay Area right around April 14th, shortly afterward. And they said now everything will calm down and people will look for normal sources of information on companies, and they had someone they were interviewing, and they said, yes, now people will be not looking at those other sites, they'll just be looking at the Motley Fool. And I said, well, the Motley Fool, albeit a great site, really is not quite the source for fundamentals. At the same time, customer behavior changed. There is not a person who buys a car today that does not go to a site like Edmunds.com and bring the information with him. So themes like democratization, empowerment, ubiquity, those became facts very suddenly. And it has changed the market map forever.